So I think we made this journey. We used to be focused on the assets only, the portfolio, and after the great financial crisis, we took a big hit on the portfolio, so we lost 25% of our assets at that point in time. And that's when we realized it was really important to focus on both the assets to make the returns, but also to look at the assets in a liability context, because ultimately it's the liability that you have to pay out over time. You can't just be looking at the assets by themselves. So my advice to others would be, the sooner they start looking at the liabilities, the better off they'll be, so that then eventually the company is not left with a huge bill to pay. So I think this whole aspect of looking at the liabilities and knowing what kind of returns they need to get, rather than worrying about what their peers are getting or whether they're beating the benchmarks, etc. So that's why I introduced this concept of the defeasing rate, which is in a sense a simple measure of the benefit payments that have to be made over time and what your portfolio really needs to return to make those benefit payments, which is, in our case, that number for us is under 5%, whereas our expected return on the portfolio is 7%. So what that says is you have a whole 2% of risk to take off the table. So it's useful to look at that. I think there's a whole range of them. Like we've seen at this conference, there's a lot of people that focus on certain niches, whether it's geography or type of real estate, whether it's lodging or housing and so on. So I think it comes in all possible variants. You have managers that offer very diversified portfolios, and you have some that focus on niches. Large sizes, small sizes, there's all kinds of things. So in oil and gas, for example, there's oil and gas, upstream, downstream, midstream, infrastructure, etc. So there's no shortage of investment opportunities, and especially as public markets tend to get frothier and more expensive, a lot of investors are looking to alternatives to increase their returns. So we tend to have fairly diversified portfolios. I have a very small staff, so we can't do direct investing. We have to go with general partners, so we would be a limited partner in those. And the things that we choose to do are, we have long-term return expectations. We also have a long history. We've been doing this for about 30 or 40 years. So over time, we have an idea as to what the risk-return characteristics are and how that fits in complementarily into our portfolio. So that's what we do. We don't make long-term forecasts for either where the economy is going or whether certain asset classes are going to do better than others. Our whole objective is to have a long-term asset allocation relative to our liabilities, and then we want to move slowly in order to get to those targets. And we do have some leeway around the edges. If something is up a little bit, we can let it be for some time, and then we'll gradually bring it. So we continually rebalance our portfolio, so that way we're not making big moves all of a sudden. And we generally don't go for home runs. We will go for the singles and doubles. We want to be above median in a consistent way. So we just take a very deliberate approach towards managing the portfolio.